Hello, I'm Amanda Packel from the Rock Center for Corporate Governance here at Stanford. Welcome to the second Kirkland Ellis Law Forum, an annual event made possible by a gift from partners of Kirkland Ellis and the Kirkland Ellis Foundation. Stanford Law School and I are particularly grateful to Kirkland, not only for the generous gift, but also for the invaluable time that several partners devoted to making tonight's event happen, so thank you. The forum is intended to focus on emerging issues in law and business, and this year's topic, as you know, is trends in activist investing and its impact on the M&A market. We've assembled a great group here, so I'll just quickly introduce the panelists and then let the discussion get started. We have, from Kirkland Ellis, we have Daniel Wolf, who's a partner in New York, who focuses on mergers and acquisitions, representing private and public companies and private equity firms in domestic and international transactions. Josh Zachariah is a partner at Kirkland Ellis in San Francisco, whose practice focuses on M&A, corporate finance, securities, and general corporate matters. And Paul G. Parker, co-chairman of Global M&A in the Investment Banking Division of Goldman Sachs. Paul has over 29 years of M&A banking experience, so he should have some good insights for us. And last but not least, our moderator, Joe Grundfest, who in addition to being a professor here at Stanford Law School and founder and co-director of Stanford Directors College, and a former commissioner of the SEC, also has significant experience as a public company director. He previously served on the board of Oracle and is currently on the board of Financial Engines and KKR. Joe?
Thank you, Amanda. Thank you very much. We've got an absolutely spectacular panel, and I hope everybody has a look at this panel and appreciates the sartorial irony that we've arranged over here, all right, that our bankers and lawyers are tieless. The guy from Silicon Valley is wearing his best investment banker imitation uniform, even down to the purple tie. Paul, there you go. All right, you must be aware that there is a dress code, and I know that when I'm going to be dealing with the investment bankers, in order for them to feel like I'm a member of the tribe, I have a collection of purple ties. I have 3. All right, it's very important. Those of you going into the business need to know how it works. One of the first things you do if you wind up either being an investment banker or a lawyer who's going to relate to investment bankers, you need 3 different purple ties. There are different tones of purple. There are different patterns of purple. If you wind up heading in that direction, come see me. We'll head over to Nordstrom's. It'll take 10 minutes, all right? It'll put you back about $200, all right? You don't have to go for the really, really fancy ones, but we can do the purple ties. Very, very important.
Joe, do you have your BlackBerry?
No. Blackberries is too retro.
We're really going to try to fit in.
Blackberries way too retro. All right. Now, what's really terrific about the panel that we've got and the topic in terms of shareholder activism is I woke up this morning, I opened up the newspaper, and I immediately said, yay. All right, this is fantastic. We can spend the entire session talking about the issues that are on the front page of the Wall Street Journal today. And for those of you that don't follow this world very, very carefully, let me just describe what is going on. A activist fund by the name of JANA Partners this morning announced that it had sent a letter to Qualcomm. They didn't even file a 13D. They don't have a 5% position. And they wrote a letter. They bought a $2 billion position. And they wrote a letter publicly proposing that Qualcomm separate its business. Qualcomm really has 2 lines of businesses. One line of business is they make chips. Another line of business is they wind up getting licensing revenue off of patents. And about 2/3 of the company's profits actually come from the royalty stream. And the major proposal is, let's split these into 2 businesses. The company has already announced a $15 billion buyback. But if you announce a $15 billion buyback in today's world and there's an activist at your door, what's the activist going to say? It's predictable. Buy back more. $15 billion, it should be a $30 billion buyback. Well, you say, okay, we'll buy back $30 billion. $45 billion buyback, okay? So they've already announced a buyback. And the thing that's really intriguing as well is that it's obvious that the company has considered this split-off strategy. And in fact, in the year 2000, it filed a registration statement to actually split the company off, looked at it, and for a variety of business-related reasons in 2001, undid the proposal. Now, what's really intriguing here as well is the company's stock price this morning jumped at the open from $69 to $72. But during the day, if you have a look at the stock price, it drifts back down, so it actually winds up closing below its close on Friday. It closed at 68.73. The Friday close was at 69.16. So on a one-day mark-to-market basis, John lost money today, which is not the usual result that we see in the market. Now, there's so many interesting things that are going on with this particular situation that just actually happened in the world today. Let me just start with a real simple question. How atypical or how typical is this event at Qualcomm of the current wave of shareholder activism that we're experiencing in the United States? Is this unusual? Is this common? If it's common, what are the commonalities? If it's unusual, where's the difference? Dan?
Yeah, I think when you hear a lot about the trends you're seeing in the activism market, this probably captures at least half of the ones on the list. And when you see the trend pieces, you have large company targets. Until about 2 years ago, the activism was concentrated in small companies. It was thought that the large companies with $100 billion market caps were immune to activism. Now you're seeing, probably we said about 40% of the activist campaigns are against companies with those large type of market caps, the Microsofts, the Apples, the HPs, the DuPonts, and I think Qualcomm fits right into that trend. A second trend we're seeing is technology companies. Again, I think there was a perceived immunity of technology companies because of their business models, because of their growth stories. And I think, again, that has completely turned on its head. And actually, some of the more prominent activist campaigns have targeted technology companies because I think some of the playbook that the activists try to deploy are underutilized in the technology space as compared to some of the more traditional industries they've gone after. Then I think, a third one, and I'll pass it on to the rest of the panel, I think, is you highlighted the fact that they didn't file a 13D. As I'm sure many of you know, the 13D filing requirement kicks in when you own 5% or more of a public company. Now, in the past, it was thought you had to take a position in excess of the 13D threshold really to have the credibility with the market to advance these types of proposals. If you took a 1% position, no one would take you seriously. You had to really put your money where your mouth is. It used to be the phrase they would use. And now I think it's a combination of larger targets and therefore real absolute dollars, don't get you above that 5%. But even in companies where, they don't have these Qualcomm type market caps, you're seeing people taking smaller positions and being able to agitate and get results with a sub 5% position because I think you have this group of folks who we refer to as the wolf pack who are going to pile in behind someone who takes it. So it's not a single person who's taking that 5+% position, but by taking a 1 or 2% position and going public with it, you're able to get a whole group of people behind them and has the same effect on the company as if you yourself, the activist, had taken that sizable position.
So Josh, could you expand a little bit on this phenomenon that Dan mentioned, what he called the wolf pack and the dynamics of the wolf pack, how wolf packs form, all right, what the rules are for behavior of a wolf pack?
Sure.
Right.
So one of the phenomena that we're talking about here is the number of institutional investors that we're seeing in stocks starting to actually actively seek out activists or aligning with activists after being contacted by the activist holders to align with the activist position. And there are certain legal considerations that go with that in terms of disclosure. If the activist is a 13D filer, there are concerns about having to then form a group with that activist, with the institutional investors. So there's a fine line that is threaded, but the activist interest is to get as many of these large institutions to back their positions and then to pursue with the united front to management and the board to achieve their objectives.
Yeah, so you don't need that 5%. You just need the ability to persuade other people who will get you, all right, the equivalent of the 5%, the 10%, and the 15% in order to get there. Paul, what other similarities do you see between, or differences, you see in terms of the JANA Qualcomm situation and other types of activist behavior that we see out there?
Well, part of it is a phenomenon of where we are in the overall M&A market and the M&A environment. So last year, the M&A market was up to $3.5 trillion, which is 46% above the prior year. And this year, it's already up 25%, so $1 trillion year to date. And very low rates, very high multiples, higher than historic averages. And so when a shareholder, activist or otherwise, proposes something, break up the company, sell the company, buy shares back, the math works almost under any scenario. And so there are a lot of things you can put on the table they may not make strategic sense or long-term sense or invest in growth of the company, but they can make mathematical sense, certainly in the short term. And so you're seeing a lot of success from what's been proposed, and the passives, which are the index funds, which are investing in the broader market, are now having enormous success because we just said the multiples and the stock market levels are at the highest ever. The active funds, which are the active managers and charging higher fees than the passive or index funds, are finding themselves behind and having to justify those fees. So what are they doing? Well, they're actually putting books together and going out and talking to the activists because they don't want to be the ones publicly making the case as to why this change should happen. They're doing it very much.
So, Paul, what you're suggesting is when we go back to the dynamics and the rules of the wolf pack, it's not necessarily that it's the wolf who stands up and says, let me form the pack, that there is a pack that basically says, we need to find a wolf, all right, who's going to step out so that,
You got to watch the name.
No, that's okay.
Sorry.
No. What I'm surprised, Dan, what I'm surprised is, notice, I went from Wolfpack, I immediately went, to Josh, and what I was wondering was how long it would take for people to sort of say, hey, wait a minute, we've got the wolf, we've got the lead wolf from the Wolfpack here.
I'll change my name to Packer, so both pieces.
So the dynamic that you're talking about is really fascinating, that you've got the activist funds, say they're overrepresented in a particular position, they want the event to occur that will unlock the value of the investment that they've already made. They see the activist as being the sand that will be in the oyster that will generate the pearl. So they actually go out and they actively attempt to find someone who will stand up and bear the transactions cost of being that 1%, 2%, 3% holder to rabble-rouse.
Well, they're hoping they're the mortar and the bazooka because they don't have the patience of sand in the oyster. But it's the same concept where they're trying to immediately make something happen. And if you take one example, Hertz, for example, 6 different activists showed up at the doorstep at Hertz. Why was that? It was like a bad blind date. They all got this book from an active shareholder that said, hey, why don't you go into Hertz and go make something happen? They all showed up and realized, the same day.
It's too crowded.
And then they're kind of stuck because it wasn't that big a company that they could have enough liquidity to move in and out. And then you had Carl Icahn, who was trying to do the backstroke as fast as he could because he didn't want to be identified as something that had all those people in it. He waited until that got sorted out, and then he went back in. So absolutely, that's what they're doing. And if you think about the size of these funds, right? So in aggregate, it's $230 billion. If you think about that in the context of the overall stock market, it's not that big. But it's grown from less than $100 billion a couple of years ago. So it's had a 25% compound annual growth rate in the size of funds. And so if that $230 billion, JANA has $11 billion. And to make that enormous $11 billion investment have to work productively for them, they have to go into bigger and bigger companies. And if you tie it back into what we're seeing, the highest levels of cash on record for companies, the highest concentration of that cash happens to be in technology companies. So $3 trillion sitting on corporate balance sheets. You've got over $400 billion sitting in Silicon Valley, some offshore, but sitting in Silicon Valley companies that has to be, from the activist mind, deployed and returned either to shareholders or deployed actively in M&A situations.
Now, the thing that's fascinating about this conversation is we can now take it in one of 2 directions. I'm going to describe the 2 directions. We'll take it in one, and then we'll come back and we'll take it in the other. One, the conversation at this point has suggested that there are characteristics associated with publicly traded companies that make it possible to predict where activism is likely to occur. So in other words, you can assign a score to just about every publicly traded company that will define the probability that an activist is going to show up, say, within the next 6-month period. So one set of questions that I'm going to want to engage you on is the issue of which are the companies that are vulnerable and what are the characteristics that tend to make companies more and less vulnerable. The second observation is the Wolf Pack and the Activists Playbook. It's very thin. It's much thinner than this. Basically, you can write the Activist Playbook out on one piece of paper that you pull out of this book. There are a limited number of techniques and tricks that the activists have, and they're really quite finite. So let's approach the question this way. Let's look at the Activists Playbook. What can they do? Because then that will also tie into which of the companies that wind up being vulnerable to activist activity. All right, so what does the playbook look like, Dan? I mean, what can an activist do?
I think it's important, when you start the conversation about what activists are, is to, sort of identify the universe of folks we're talking about. I think, there's any number of ways to slice and dice it, but really you have three broad categories of, people who you would deem to be activists. You have, the social activists, which are, looking for changes to the company's employment policies, their greenhouse gas emissions. Frankly, they fall within that category, but they're, frankly, a non-actor in the issues we're talking about. There's a second sector of governance activists, which again, aren't necessarily the big investors, the names you talk about like Jana and Bill Ackman and Dan Loeb, but they play a facilitating role for what the third category, which are the economic activists, are, because what these governance activists do is attack what they perceive to be, or what certain academics in the market perceive to be, weaknesses in corporate governance, and largely force companies into positions where they're dismantling structural defenses and thereby facilitating entry points for our third group, which is the one that's garnering all the headlines, and I'm sure people are most interested in hearing back, which is the economic activists, who are largely looking for events, because, as you said, their playbook is pretty thin. They're not just investing in the stock and coming in and saying, the company needs to be run better. That's not a great playbook. What you need is some dynamic that's going to change the market's perception of this company and generate, what we all refer to as the alpha, some excess market return. And, what can you do in order to do that? You mentioned a few of them. You can spin off a company. You can force the company to sell itself. You can force the company to repurchase stock. You can force the company to, adopt a particular strategy, licensing your patents. There's people out there pushing companies to, stop hoarding its patents and monetize your patents. But at the end of the day, what they're looking for is a monetization strategy that will be rewarded in today's market environment. So I think, once you sort of break that down in those categories, really, like you said, the playbook for the social activists and the governance activists has existed for a long time, and it's people who, sort of serve a role to facilitate the economic activists and their limited universe of things they can do.
So let's break this playbook down. We've got the economic activist playbook and the governance activist playbook. Paul, when you see what people are recommending as change at companies that you advise, how does that playbook, how does that economic playbook, pan out? I mean, what are the moves that they have?
Well, first they start with the universe of, and it's a screen that everybody has it. The bankers have it, the attorneys have it, the activists have it, the regular shareholders have it, now the companies have it. It's fairly public in terms of what is available. And you start looking at, obviously, any operating performance, and you can tell if someone's in operating trouble. But set that aside even for a second. Then you start looking at some basic screens of leverage. Are they relative to the peer group? Do they have the same amount of leverage as their peers? Do they have the same stock performance as their peers? And specifically looking at 1, 3, and 5 TSR, total shareholder return, which incorporates the stock price increase or decrease and the amount of dividends or buybacks that are done. And you look at those returns, and you couple that with the shareholder advisory services like ISS and Glass Lewis, who very much focus on these returns to see whether they'll support a company or not. And you can start to find a pattern of those companies that are vulnerable have some weakness in their stocks, some weakness in their capital returns, some weakness in their leverage policies, again, weakness defined by the activists. And then, God forbid, they have any kind of operating stumble that's going to create a negative event in the stock price and an entry point. And so they look for these entry points, and then they go in. So they're building a position. And again, out of that $230 billion they have to work with, they also have derivatives, which might give you a multiple of 3, 4, 5 times that number to start building up a greater position in the company. Then they figure out what's the greatest lever point that they have. And in many cases, it's the actual governance. They'll go in and use that as the wedge to say, the board, not always the CEO, much more focused on the board these days, the board is not doing its job. And we can see now, because they don't have a split chairman-CEO role, their tenure is too long on the board. They've been on, for too many years. They start to assess whether they're quote-unquote overboarded, whether you're on 3 or 4 boards, how could you possibly have this focus? And then they say, and that's why these results aren't what they should be, and you're not really keeping the company crisp. And they start to make that case, and frankly, very quickly ties back to this, the Wolfpack, not only the active investors, it's also other hedge funds. And on average, if hedge funds are owning 18% of a company stock, within days of announcement, it jumps up to 46%. And then getting that vote to make something happen becomes a foregone conclusion. So that's the playbook, is shock and awe, force against anybody who shows a weakness and isn't actively, quote unquote, managing to this set of criteria.
So one mechanism that actually makes this possible is changes in governance mechanisms. So we've got this separate group of activists, the governance activists, and sometimes they operate very aggressively, sometimes they operate in a very sotto voce manner. Josh, could you take a few minutes and explain what are the big changes that the governance activists try to make happen, and how those changes make life easier for the economic activists, because this is a symbiotic relationship between these two different styles of activists, each supporting the other.
Yeah. So really starting in 2003 to the present, the governance kind of defenses that a lot of public companies had, especially in the S&P 500, those have gone from, for example, classified boards, meaning the boards are staggered, the directors have staggered terms, which makes it much more difficult for an activist to come in and remove all of the directors or get a majority of the board in one fell swoop, but instead it would take them, in some cases, up to 2 years before they can actually take control of the board. Or where companies had what's called a poison pill, which prevented takeovers of the company by making it very dilutive for an acquirer to come in without the support of the company. Those two types of defenses were in the 60-70% range for S&P 500 companies in 2003. Now we're looking at around 6-7% of those companies have those types of defenses today. So there's been a real dismantling of those types of governance mechanics. Same thing with the CEO of the board, CEO of the company being the chairman of the board as well. We've now seen a trend towards separating those roles, such that you have an independent director act as the chairman of the board, separate from the CEO, to have some more control over the board and governance. So those are some of the examples of what we're seeing being targeted by these governance.
And I think one of the things is, it used to be, because of the existence of those defenses, pushing for change required patience. And one of the things that these people don't have a whole lot of is patience.
Right.
I mean, they're among the most impatient people you'll ever meet, both by constitution and by investment philosophy. And I think, the dismantling of the defenses has really removed that necessity for patience and has facilitated this ability to come in with a shock and awe and produce a quick return and, get in, get out if you produce results.
So understanding, I think, the ecology and the symbiotic relationships in this market is something that's really necessary if you're going to survive in it. And I think a lot of people outside the market don't get it, right? In the sense that what you have is the governance activists, they put their changes in place, they make it much easier for the economic activists actually to be able to succeed. The social activists also have an interest in facilitating anything that causes change within the organization, and therefore they also have an incentive to ally with the governance activists and also with the economic activists in that situation. And once you've got these three different constituencies all pointed in the same direction, you create an environment in which things can happen relatively quickly. Different forms of wolf packs, all right, can actually form. And the activity that we're seeing today, including the 120 or more billion dollars that's now dedicated to this field, becomes a rational amount to put in only because you've got these other changes that have actually occurred in the marketplace. And this is something that's happened relatively quickly.
Well, just a point in terms of what's been occurring in numbers. In '09, there were 44 campaigns. There were 101 last year, and we're on pace for 130 this year. And so that gives you a bit of a
Explain to the room, Paul, what you mean by campaigns.
So an active proxy contest where someone's putting up a slate to change out the board. And again, most of early days, people put up a full slate, or tried to, and then they had to really focus on those that didn't have staggered boards. But now they're turning that to be a partial slate and putting them up, and they're finding over 68% success rate in doing that. And they're also finding, and we can't forget ISS and Glass Lewis, the shareholder advisory services, again, they're recommending in over 65% of the time that you vote in favor of the dissident slate.
Now, this is a huge part of the change in the ecology, and let's unpack this. So first, we've got a tremendous increase in the number of situations where we're actually having what's called short slate proxy contests, where the activists are saying, we don't want to take over the full board, we just want 2 or 3 of our people on a board of, say, 10 or 12. All right? Now, first thing that's really interesting about that is many activist situations get resolved well short of the actual proxy contest. So the proxy contest, in a certain sense, is the end game. It's a situation where you have the dispute, you're unable to resolve the dispute. The number of situations involving activism, typically a large multiple of the ones that actually wind up going to a board contest. Now, when we go to the board contest today is very different from what the board contests looked like 10 years ago. All right? Many different things are changing. Talk about the quality of the directors that activists are often putting forward.
Yeah, I mean, just to amplify that point, I think, that has been one of the smart evolutions of the activists is they used to put up full slates, try to take a majority board or the whole board, and I think they realized that, they'd have a lot more receptivity from the ISS, the world, the institutional investors, if they went for this short slate. In other words, not trying to replace the whole board or majority of the board, but only try to put a few people on the board. And, that has translated into much more successful proxy contests. As you said, part of that, and, when you couple that with the improvement in the quality of the nominees that they're putting up when they're trying to put people on the board.
Well, expand on that, because I think that again is another change that many people outside the business are unaware of.
Right. I mean, I think, like you said, 10 years ago when for an activist to put up a slate, they'd have to look pretty long and hard to find people, and they tended to
and they'd often find their brother-in-law or,
it would be friends, family, anonymous people, or people of questionable, biographies. And, one of the first things you did when you had a proxy contest was you'd go and do background research on these people, and you'd find they were involved in some SNL, collapse in Texas in 1988, and those are the people who were willing to do it. Now, when you get these proxy contests, I mean, you're talking about seeing former CEOs, CFOs, former investment bankers, on these slates, and there's not a whole lot of background research you know. Either you already know them, or if you type their name into Google, their biography comes up, and sort of the Business Week, Fortune biographies of anyone who's ever been a director.
You're acting like you would actually be having lunch with these people. You're willing to be seen in public with these dissident directors.
Frankly, they are the type of people who, when you were looking for nominees for your own board, they could have very well been that. And I think that's a sign of the credibility that the activists now have with the market, that people are willing to associate with them. And, that has changed the dynamic, because you no longer have an answer where you fight a proxy contest on, do you really want this cast of questionable characters running your company to... you're not winning on that basis anymore, because their nominees are just as credible as your nominees. And therefore, the fight shifts to, hey, what am I proposing? What are you proposing? And it becomes a business strategy debate. And inevitably, I think most companies perceive that there's a pretty decent chance they're going to lose that debate. And that's why you're seeing a whole lot more settlements rather than proxy contests. There are more proxy contests now, and the number of proxy contests that go to completion as compared to before is a lot lower on a percentage basis.
Correct.
On an absolute basis, there are a lot more proxy contests, but 10 years ago, from ones that were commenced to ones that went to completion was a much higher percentage. Today, you're seeing people settle out.
Well, and to that point of proxy contests that get announced, where someone's putting up a slate publicly, in '09 it was 8% were settled, and today it's 38%. So that gives you the trend line. The number that we're all working on that settle before they ever see the light of day. Just did one this morning. I mean, literally, they happen all the time.
That's exactly
and so
right.
That is where, I'm here with all my artillery. Do you really want to fight? And by the way, I've paid a search firm, the same search firm you would use to find a director. I've just paid them to hire a director that I can put up. And so it becomes very difficult to say, well, we don't want a director, and especially when it's, ISS says, why not have some fresh blood on the board? What does it hurt? And that's what you're fighting against in terms of this debate. How could it possibly hurt? They're qualified. Put some fresh blood on the board. Your tenure is over 9 years. This person's been on for 15 years. Shake it up a little bit.
So one of the interesting things that I hope people in the room are hearing as a result of this last part of the conversation is that to call somebody an activist is no longer an insult. All right, that 10 years ago, you would call someone an activist and you'd say, well, you're implying that they're an amoeba-like life form. They're early protozoan stage. You can see the cilia on them when they walk into the room. But now, my goodness, they look just like you and me, and they even wear purple ties.
Well, some of the more known and respected ones actually themselves, when you're meeting with them, say, we're active shareholders, not activists.
Shareholders,
I was
right.
Googling something this morning related on this topic, and it went back to 1978, and they were called insurgents.
Or terrorists, So one of the things that's really interesting, and let me just get a little technical, for a moment. Everybody, please forgive me. This is, after all, a law school. There was a fascinating situation that recently occurred at Sotheby's. All right, when we were just sort of chatting, and it was a situation where somebody described it as a board snatching defeat from the jaws of victory, and it I think describes emerging tactics that some of the activists will be using on a going forward basis. This is an area of a tremendous amount of innovation, and some of the innovation is legal innovation, and this one strikes me as so cheap, so low rent, and potentially so valuable just in terms of the leverage that you get by applying this kind of a tactic. I'll be shocked if we don't see much more of this coming up. Dan, Josh, could you explain what happens with the books and records demand under Delaware 220 and how it is that activists can use this approach?
To go back to the root problem is the inability of anyone, and it's not just, I have some teenagers and, it's given with them, but you'd be surprised at the number of, people in their 50s and 60s that can't resist the urge to put every thought that they have in email. And, that has been the greatest source of downfall in, corporate America, for the past 10 years. And every time we start a deal, you do it too. Our first speech is, you need to keep everything confidential, and please don't use your email. And the guy's, sending an email while you're sitting there. And, what really happened in Sotheby's is, litigation has, sort of, what it looked like to the outside was, sort of some very high-minded litigation. What happened, an insurgent showed up at Sotheby's, the auction company, and Sotheby's, to defend itself, put in a poison pill. And we had really high-priced legal talent on both sides, litigating in the Chancery Court of Delaware. It went up to the Supreme Court, the question of whether the particular poison pill that they put in place was legal under principles of Delaware law. Guess what? It had nothing to do with that. What this was an opportunity for the insurgent to bring out into the public realm the debate that was going on and get the opportunity to get discovery. Those of you who know anything about...
You start litigation about anything,
Yep.
All right? You then wind up getting discovery. As soon as you get discovery of a board of directors' emails, typical board, 12 people, all right, out of a group of 12, what's the probability that there's one idiot, all right, that winds up, putting inappropriate stuff in the email, all right? Then what's the probability that there are two idiots and that they're communicating with each other? I mean, the numbers go up. The numbers go up.
And what you end up having, as you said, it's amazing. They won the litigation. I mean, we were all waiting with bated breath on the litigation, and, they won an amazing victory. Their high-priced legal talent got the Delaware courts to bless their poison pill. The next day, they settled, put the insurgents on the board, and agreed to, most of what they were asking for. And you sort of say to yourself, like, but they won in court, but that wasn't the point. The stuff that came out in the litigation, the emails, the pettiness, it used to be that it was the insurgents. Those of you who go around in, 05, 06, 07, some of the early activists, they couldn't control themselves. They'd send these letters, criticizing people for eating too much steak. And, they were called pirate capital, and, they acted like pirates. But at the end of the day, right now, with these litigation tactics, it's becoming apparent that the pettiness and the questionable judgment exists on both sides of the fence. And by putting the litigation out there, what you're able to show is both of us are a little bit immature, both of us are a little petty. So that becomes a level playing field in that regard. So what you're seeing is various forms of litigation. You mentioned 220 demand. That's a Delaware tactic that gives any shareholder the right to see all the books and records of the company. It was a very little used litigation tactic until fairly recently. The Delaware courts take a very expansive view of what you can get if you file a 220 demand. So what you're seeing is litigation become not an end in itself, but a part of the overall tactic to bring out into the public realm the debate that they'd like to have.
Major law firms now have partners who specialize in bringing and defending 220 litigation in Delaware, these books and records requests. And there was, a recent very major decision out of the Delaware Supreme Court dramatically expanding the type of information you can get and the circumstances under which you can get the information. And you don't need to start a huge lawsuit in order, in effect, to get discovery. And even if the discovery is subject to a confidentiality order, you then know what the weakness is. You know the embarrassing emails. You then sit with the board of directors, you sit with the CEO, and you say, guys, look, there's a bomb waiting to go off. And the only question is the circumstances on which this bomb is going to go off. Why don't we make this go away? All right? You help me make a few $100 million, and these embarrassing emails never need to see the light of day, and, we can do whatever it is we need to do. Josh, Dan, is that fairly accurate?
I think that's fair. And I
was afraid you were going to agree with me.
Hopefully this does not result, though, in the chilling effect of the robust discussions at the board levels about the various value maximizing alternatives for stockholders, because there are these debates and these happen all the time. But I think the point here is to make sure it's not in a discoverable format, because again, at the end of the day, the board is looking for these value maximizing alternatives.
But it's interesting when we talk, especially out in this part of the world, technology being disruptive, and you can see a number of things you can string together. One, the access that the internet has given these activists has given them a real voice, and a cheap one, right? So they can really get to a lot of people very inexpensively, which has helped them a lot. Two, you think of this discovery on emails, but even further, take it down another level, especially when we're doing M&A transactions, and most of the M&A transactions above $500 million, 95% of them are finding themselves, Delaware companies are finding themselves under litigation. And part of the
100% is closer to the number. Yeah.
And part of the litigation, right, we're finding now, and what boards were told by attorneys is don't take notes, don't write anything down, have the books themselves be very cleansed from real thought and detail. And of course, Strine now comes back and says, "Whoa, I want red line changes to anything that's happened in these books from this time to the last time. I'm going to go back and look from your pitch books, not just your actual deal books, but the ones that when you were considering doing this. And I'm also going to find out, because if you're delivering electronically these books to your directors, I'm going to look at the portal to see if they actually went online and spent any time on the book." So,
well, these portals, by the way, they have switches so that you can set them so that they don't keep track of that information. Or, on the other hand, you can set switches so that they have a full audit trail.
Right.
All right. And I'm not going to give anybody advice about how you should do those settings. Go talk to your general counsel. All right, and make sure you have your privacy settings. All right, both on your board books and on your Facebook pages, set the appropriate way.
And then the last thing I would say that people are doing is also taking subpoena of the actual personal hard drives of directors.
Yeah.
And it's the other part of this phenomenon, the shock and awe, is really directed to the directors who, again, many of whom have been CEOs or prominent folks, are sitting on these boards, and here they are, maybe a bit older in the last bit of their career, and the thing they're facing now is a bazooka that's saying, not only am I going to question everything you've done at this company, I'd also like to see what emails you've sent, on a personal level. I'm going to see them when I look at your hard drive, and they're taking those hard drives away.
Well, you're not. I have my own personal email server guarded by the Secret Service. No, you're not getting that.
You and Hillary Clinton, right?
That's exactly right. Sure.
I know Hillary Clinton, and she's a friend of mine. You know Hillary.
Right. I'm no Hillary Clinton. So speaking of me not being any Hillary Clinton, one of the issues that's very big in the legal community and among the governance community and the governance activists is this big push towards proxy access. And some major corporations have picked up on this. General Electric, for example, voluntarily adopted a proxy access proposal just 2 or 3 weeks ago. Could you guys explain what proxy access is, why it is that some people think it's a really big deal, and why all three of you in our conversation before this session were unanimous that it's a molehill, all right? It's nothing that's important in terms of real activism. Maybe it's something that's important in terms of social activism, but in terms of really changing the economics of a company, who cares?
I mean, just briefly. I mean, take a step back. A few years ago, the SEC tried to implement a rule. One of the challenges of trying to get launch a proxy fight or try to get directors nominated to the board is that under the existing SEC rules, you had to run your own proxy statement, which had a significant cost associated with it. Certain shareholder proposals under what's known as SEC Rule 14A8, you can put a proposal into the company's proxy statement. You just send in a letter saying, I'd like shareholders to vote on it, and that's practically all you have to do, and the company's required to let shareholders vote on it. Putting directors up for nominations was an exception to that, and it was viewed as a significant obstacle to people challenging the board because most, our economic activists have lots of money, but the social activists, the governance activists don't really have the money or time.
And back up for a second. Let's put some hard numbers on this. If I actually want to run a short slate and get 2 or 3 directors onto a board, how much is it going to cost me? Give me a range.
I think depending on how, sort of the whole PR aspects. I mean, I think we estimate anywhere between $750 to about $3-4 million, depending on the length and how public the contest is. So, a lot of the social activism we were talking before comes from labor unions, the Sisters of Mercy, Carmelite nuns. There are people who spend time putting forward shareholder proposals. The SEC tried to implement a rule, the proxy access rule, which would change that and put director nominations into that other category where people were able to access the company's proxy statement to put a limited number of directors on. The business community got together and challenged the SEC's rulemaking in court and surprisingly won that lawsuit. And the SEC dropped the rule. So what ended up happening is, the word we use is private ordering. What ended up happening is the activists decided, well, if the SEC rule is going to be disqualified, what we're going to go do is try to force companies to change their own rules to put in their charter or their bylaw documents something that replicated the SEC proxy access rules. And that has become the hottest sort of governance topic in last proxy season and this upcoming proxy season, people trying to change that and get companies to put into their governing documents this proxy access. So it would seem like it's a very, a huge intersection with all of this activism that we've been talking about, all these people who want to affect all these economic changes of the company, that all of a sudden now there's a governance change that's being pressed on U.S. companies to allow people to put people onto the board of these companies at low cost. So that's the background on proxy access. I think the overall reason why we think it really doesn't have that much to do with sort of this broader activism topic, despite, I think they get linked a lot. You read columns in the New York Times or the Wall Street Journal and you think that it is the development that's going to push the activists to the next level is, in reality, the true activists, the ones who are putting money behind it, are not going to be scared off by spending $750,000 or $2 million on a proxy contest. Also, these proxy access rules limit the number of directors that you can put up, whether it's the number of directors, the percentage of the board, and you have to have held a certain number of percentage of shares for a certain number of years. So whether it's 3% for 3 years, 5% for 5 years, none of these activists have held stock for a very long time. So it really isn't a tool for these economic activists who are trying to come in, shock and awe, build up a huge position, affect quick change, and get out. Really where it's going to be valuable is to some of these social activists or to these governance activists where all of a sudden the cost-benefit analysis of putting up a director nominee has changed, the calculus has changed, and you might see some of these social or governance activists trying to put someone on the board rather than simply making a shareholder proposal.
Well, I would say just on that, I think one thing may have an interesting opposite effect is because many of the social and governance folks, particularly in the passive community, since they're passive, which means mostly that they're index, they're buying large categories of stock. They're not stock picking, but they do care when these contests come up about certain things around governance. So if they start moving with some of the other social activists into this category of being taken care of, if you will, under proxy access, then they're less available, in my opinion, to the economic activists to follow that slate. So if the economic activist puts up their own slate, as someone who defends companies, I'm going to say you could fall into this bucket where you could be part of this group that is going to have 25% of the nominations for the board. Why should you have your own separate slate or a separate consideration? By the way, you only own 1.3% of this company. And I think that's going to be a harder argument for them to make.
So we've seen a tremendous amount of change in this sector over the last 5 years. I think we would have looked back 5 years and we said, predict out, what's going to happen in 5 years. Very few people would have accurately forecast where we are today. So now, with that sense of humility deeply imbued in us all, I'm going to ask the three of you, where do you think this market's going to go over the next 3 to 5 years? What kind of innovation are we going to see? What kind of changes? Is it going to get bigger? Is it going to stop? What could cause this trend basically to reverse? What could take this trend, which is already pretty active, and put it on steroids? And then we're going to go to questions from the audience.
I'll go first and just say, I think the thing you pointed about the Qualcomm stock price, may be indicative of something that you're going to start seeing in the market. One of the things that we do as advisors is, I think, 3 years ago, 2 years ago, sort of people were very reactive. Activists showed up, and it was the first time that there was any sort of introspection about how did you end up on that screen. I think now most companies, or at least companies that have their eyes open, are doing a lot of pre-inspection of themselves and looking at themselves. And many of them are taking the steps that an activist might have come in and agitated for. You gave the example, Qualcomm. It looked at that spinoff itself. I mean, they're sort of, well ahead of the trend. They announced a $15 billion buyback, fairly recently. So I think, the thing that could cause this trend to slow down, or at least, sort of start to make it harder to get the results that some of these activists have been getting, is the fact that the low-hanging fruit is gone, and a lot of the companies will have, self-deployed some of the easy picking tactics that some of these activists are going to do. Because, I think 2 years ago, if someone had shown up at Qualcomm and done this, I think their stock would have been up $10 and would have stayed up today, just on the excitement that something is going to give. The fact that the stock really didn't react in a positive way, I think reflects a judgment from the market that there's not a whole lot here that's likely to happen or easy to happen despite Jana's agitation. So, I think that's both indicative of a trend of, sort of what is going to happen and what could slow this down, which is, sort of companies doing it themselves.
That it's really all about the money, and if they can't make any money doing this anymore, they're going to stop doing it? Is that what you're trying to tell me?
I'd like to say they have deeply held views about what's right and proper, but no, it's all about the money.
Okay, good. I'm relieved. Josh, what do you see happening?
One additional trend that we're seeing, this played out earlier this year with Pershing and Allergan, is that as activism becomes a little bit more mainstream, you're going to see them starting to get partnering up with strategic bidders. It's yet to see kind of what strategies they're going to use to implement that, but in connection with M&A activity, given that there's now $200 billion plus and rising, flowing towards these activists, they now have a lot of liquidity that they can then deploy, partnering up with strategics to target M&A activity. So I think that's one trend that we might see an upswing.
Paul? So I think a couple things. One, this is, in my mind, a very much of a bull market phenomenon, as, again, the low rates and high prices give a lot of credence to almost any math that you put on the table, and the fact that the active investors are feeling so much pressure with higher fees than the passives who are outperforming them. If that reverts and the passives and the broader markets don't do as well as active managers, then I think the active managers start to push a little bit less or jump in less behind the activists. That said, we've also had this change in the boardroom. Frankly, people are paying attention, and I can't tell you how many CEOs today say, I want to be my own activist. I don't want someone to do this to us. And so whereas the cozy or incumbent or old white guy boardrooms, they're starting to fade away. And I think that's going to have a significant shift as well in terms of the case that can be made. And if people are being active on both financial management as well as governance, it'll make it less interesting to do. The other thing is, what are the numbers going to tell over time? Despite all the case that the economic activists make, because they're usually coming in with some case around strategy, around growth, around investment. The fact is R&D is dropping, investment's dropping, CapEx is dropping. It's a wealth transfer from employees to shareholders, which again may not be a bad thing, but within 18 months of a campaign, the CEO is usually gone. Within 4 years, half the companies are sold. And buybacks, again, are at all-time highs. This isn't necessarily leading to real growth for our economy and growth in these companies. It's leading to financial engineering and a return of capital, which has to be deployed somehow. There has to be a place for companies who want to make investments to be able to do that. And the question is whether they're going to be able to do it in the public market or not. 22% of these companies are sold to private equity firms. They're taking themselves out of the public markets because this isn't a place to do some of the things that we should be doing. So I think that's the 3 to 5 year trend where some backlash, but we'll continue to see this for a while. The longer trend, I think, is even more interesting, where this may become more like a UK model, where, again, there is an independent chairman of the company who is leading a board that has a lot of active dialogue with shareholders, and the company very clearly runs under their mandate, including specifically the CEO and the management team. And I think that's a slightly different nuance and change, but it feels very much directionally the way we're headed.
Let's go to questions from the audience. Anybody? Come on down, come to the microphones so we can catch you for posterity. You're up first.
Don't have unclassified boards, don't have staggered boards, and don't have founders that hold a large percentage of stock.
There you go. All right, take it from the top.
Take it from the top. So Mark Andreessen said that companies that are going public now, young companies that are going public now, that don't have founders with large controlling stakes, or don't have staggered boards, are chum in the water, basically, when it comes to activists. That he said, young companies, it's never been a more dangerous time to be an unprotected public company. And I wonder what you all have seen, not just from public companies, but also from private companies, particularly in Silicon Valley. Are they thinking about activists well before they even become public? And what are they doing, if anything, to protect themselves?
Well, I think, one, because of Sarbanes-Oxley, many companies are thinking about, do I want to be a public company and live in that environment? And then it's coupled with this additional vulnerability that we're seeing as all the defenses go down. I will say for a lot of the younger companies, they do have founders who have large stakes, or private equity or venture capitalists who help protect the company a bit because of the block of shares that they have. But once that starts to dissipate, then they are typically more vulnerable. The slight twist is if they stay small, there's not a lot of liquidity, so moving in and out is a little bit harder for some of these activists who are focused on somewhat bigger opportunities, usually in the, again, $1 to $5 billion range. You have to be very certain you're going to win because you don't have enough liquidity. Once you're in.
You know, one of the things you have to realize is that all of this stuff that we're talking about activists coming in, and you have a stranger to the company that from a CEO's perspective knows a fraction about the company of what the CEO does, and their economic interest is 1%. That is so anathema to the theology of Silicon Valley that people in this community, rightly or wrongly, bristle, right, at the idea that by going public, they should then make themselves susceptible to that kind of critique by people that know nothing about the technology and about building this kind of a company. And for that reason, in Silicon Valley, people are trying to grow their companies as long as they can without going public. And people are the phrase that I use, they treat going public like catching a social disease, all right? And you want to avoid that at all possible costs. And one aspect of that disease is you're forced to do business with the activists. So what I'm seeing is in just about any situation where the economics will allow a company to go public with dual class, shares, they will do it. And in other situations where even if you can't do it, just about every anti-takeover mechanism will actually be deployed. And by the way, there's some very excellent recent research indicating that for many companies that do go public, these anti-takeover mechanisms are actually value enhancing, not value destroying, as some might suggest.
What's interesting, you do see a number of companies that are being spun off actually have staggered boards and other protections in them, because you can do that by writ as opposed to, and you just put the stock out there.
Precisely, and you're seeing the activists go absolutely apoplectic if you do a spin and the company that's being spun has a classified board, because that means the activists can't establish positions in the spin company, all right, and play the game again. Yes, please.
So I would like interest to ask a question about case study. So, for example, Daniel mentioned about Qualcomm, right? A general group has been very activist investor, and this morning they announced that they want Qualcomm to spin off, and the price go up $2.72, and then this afternoon-ish, and Qualcomm announced, the CEO announced that they will not want to spin off. So, and then the price go down. So obviously this is still ongoing process. So what's your, the panel's view about this? And this one also, I think, happens to eBay, right? eBay was spun off, eventually they spun off. So do you see that is a non-stoppable trend? Because activists, they demand a spring off, and something else like a buyback or some other activities may not be able to stop them. You see that's stoppable? What's your opinion about that?
I mean, look, I think one of the things, sort of that ultimately determines whether a company is going to be able to successfully defend against, sort of an activist, a credible activist like Jana coming in, is a company being able to show that they had a credible business strategy that they communicated to the board, to the market, to the analyst community, and to, their largest shareholders. And if they have an established history of showing that the company was not meandering, that the company had a specific direction, had a specific plan, it becomes a lot easier to build an opposite case when someone comes in and says, spin it off. I think, from what I've seen, part of the Qualcomm's argument is that the patent royalties are very important. As you pointed out, they're a significant portion of the profits to fund the R&D. And if you were to disconnect the royalties from the other part of the business, they're very hard to sustain the R&D and the CapEx that's necessary for the chip part of the business. So, and I think Qualcomm has a history of credibility with the market of pursuing that thing. So, I don't think it's unstoppable, but it's unstoppable if you don't have a credible alternative that you don't invent the day after the activist shows up. I think that really is the determinant whether something is inevitable or not.
And the royalty base is a depleting resource, and the only way that you get that resource going, long term, is by investing more in R&D.
Right.
So it's a.
They're trying to turn it into a yield code,
which is
not sort of.
Let's go to our next question.
I would just say, I'm sorry, I'm just on that. For companies that are receiving a letter or reading in the press that an activist has gone in and is announcing a slate, and they haven't done any preparatory work ahead of time, the deck becomes much more stacked against them. If they have, again, been thinking about these things and have a track record of having already thought about it, either dismissed it or been working on it, potentially doing it, and they've got a press release ready to go if somebody knocks on their door, there are things you can do defensively to take the advantage the moment someone does that. And we're seeing, by the way, activists are coming, whereas used to they'd call you and have a conversation and before they'd hit you between the eyes. Now they're just going out to the public and hitting you between the eyes because they know that companies are preparing themselves. So if you're not prepared, you're going to have the deck stacked against you.
Yes, sir.
I was interested in the slates that the activists are recommending, whether these people are being compensated somehow by the activists or whether they are being compensated purely by the board compensation that other directors are getting. Whether that presents being paid by the activists, whether that presents a conflict that ISS or other people.
This is the golden leash arrangement. Let's go with that.
I mean, yeah, great question, topical. I mean, I think it was the topic of large controversy last year. A number of the activists who were trying to get some of these more credible board members, well, sort of board compensation is great, right?
Mm-hmm.
It's a good gig, but sort of for some of these people, you might lose the proxy contest, so you put your name out there, you've engaged for a whole bunch of months, and you don't even get the board compensation. Or if you do get on the board, you get a board fee, you get some options, sort of, and then the guy who put you up is making multiples on their money, pocketing billions of dollars. So some of these people said, you know what, I want a cut of your profits that you make generated. So, you started seeing a number of these arrangements where people were agreeing to give these director nominees cuts. I think what ended up happening was you gave an easy target for the defense, because all of a sudden, instead of saying I'm putting a credible director on who's going to look after the interests of all shareholders, it becomes very clear whose interests they're going to look after, because if my profits are driven by your profits, whose profits am I going to care about? And you actually had a number of companies that actually tried to put in bylaws that outlawed the use of these golden leashes. There was a very negative reaction from the governance, the ISS community to these. And I think what you ended up seeing instead was bylaws that required people to disclose the existence of these arrangements. And it seems like the mere threat of having to disclose these arrangements have largely discouraged many of these activists from using this tactic to compensate their directors, because they realized it creates a significant credibility gap when you put up a director of that kind. It's not that they don't exist. I mean, the GM, we were talking a little bit about the GM, the guy who was nominated by a bunch of hedge funds for GM is being offered to be compensated based on the hedge fund profits that are generated. But I think that's a bit of a unique situation, because he actually went out and found the activists to try to put him on the board. So it's a little bit of a different scenario. But where you pick people, I think it's going to be less common to see those types of arrangements, just because it's such an easy target.
Let's go to our next question. Yes, sir.
Sure. Just wondering, to what extent is the discussion between the shareholder and the company being helped or hindered by Regulation FD? And also what pitfalls the management should watch out for in communicating, in conducting dialogues with activist shareholders?
It is, just to, for the benefit of the group, Reg FD was put in place, I think like 1999, if I'm speaking off the top of my head. It was in light of, sort of the controversy in the late 90s about how some analysts and some shareholders were getting inside information from companies ahead of it being publicly disclosed. So the SEC put in place Regulation FD, which stands for Fair Disclosure, which basically mandated that you weren't able to give information to any investors or shareholders that wasn't shared with the broad market. It was meant to prevent sort of favored treatment and favored receipt of information. It definitely does inhibit a little bit some of the conversations you'd like to have with these activists, and perhaps necessitates putting a confidentiality agreement in place, because that's an exception to Regulation FD if you have a confidentiality agreement. But by equal tokens, these investors may not want to sign a confidentiality agreement or acknowledge that they're receiving any inside information, because it inhibits their ability to trade in and out of the stock. So what you end up having is slightly stilted discussions. You can't really have, sort of a heart-to-heart about what's really going on because of these limitations. So I think it's a fair point that it does create a little bit of a dynamic where, the real honest conversation you might have is inhibited by either the absence of the confidentiality agreement or the absence of desire on the part of the activist to receive inside information. So yes, sometimes what ends up happening is, instead of debating off of the company's projections, you debate off of Wall Street projections or something like that, because Wall Street projections are equally available to the public. And so it does have an impact on those.
It's created an asymmetry, which essentially is an unfair fight, because management has to listen to the activist and then can't really say openly enough about the company. And then the activist goes public and says, well, I met with them, they didn't tell me anything. And so it's very, very frustrating. And we're seeing more instances, literally had one this morning, where a CEO met with the activist and we said, you have to agree that you'll be subject to Reg FD, and in fact, you won't trade or disclose any of this information until we disclose, which of course now we're going to have to do, and everything we had in that conversation, we will have to publicly disclose. That's material in nature. So again, we're finding ways to have those discussions, but it's requiring a bit of activity on both sides to be able to do that.
Yes, sir.
Within that value add capital, I don't think follows your envelope type scenario. They look at are they adding value to the various.
Hence the name, right?
Yes. So I don't.
I think that's a very fair point. Look, obviously in the context of an hour-long discussion, we have to generalize. I think that's a very fair point. Not only within the universe are there, sort of people who have different agendas, different playbooks. Value Act, and relational is another one, which I think it fits a bit in that Value Act where they try to engage in active dialogue and look to are a little bit more on the cooperative side. There's ones who are much more on the agitational, confrontational side. I think an equally important point is that, sort of the notion that activists are always bad and wrong, that doesn't work anymore, because sometimes they have decent ideas, and sometimes instead of fighting their idea, you're better off co-opting their idea. And, so I think, sort of you're absolutely right that, sort of we probably just threw like a broad, generalization about it by necessity. But I think, it is important to realize, and I think you're hearing, I think 5-10 years ago, if an activist showed up, it was circle the wagons, all costs, they're wrong, we're right, fight to the death. And that's not the defensive playbook anymore. It's listen, engage. I mean, you could not imagine 5 years ago suggesting to a board of directors that maybe some of the directors go sit down with an activist and hear them out. I mean, that concept was just foreign. And now it's one of the things that you almost inevitably recommend that. And usually it's, offering them a meeting without management present so that they feel they were heard by the directors and not just managers. So I think, because the generalizations are, too simplified, I think the responsive playbook is probably, sort of been diversified a bit.
Well, in fact, to that end, Vanguard has sent out enormous amounts of letters to companies. And again, they're passive. They tend to vote with management against dissidents when it comes down to it. But they've gone out to say, look, we really want you to set up either as a committee of your board or be part of the shareholder direct exchange, which is a new thing to come up, to make sure that shareholders are having a direct conversation with the board of directors without management so that in dissonant views or different views can be heard. And I completely agree on the continuum. I will say I've seen in almost every instance those relationship type activists who go in for the longer term. At some point, they will do the regular way activist playbook. They always get there at some point on a given situation. But for the most part, they take much more constructive approach. And those tend, by the way, I think to be better outcomes for everybody.
We're over time, so we're just going to take one more question. I see our handlers signaling to me very, very eloquently from the wings. So you'll get the honor of the last question.
Thank you. Thank you for a most engaging discussion. I had a question directed towards Mr. Parker. The last comment you made during your panel was that long-term consequences of gross and active investing. And some of the things we're seeing in America is that over the past couple of years, CapEx expenditures compared to historical trends have been falling at a rather dramatic rate. And this is a view consistent with other developed countries, Japan, the European Union, and many people point the reason that being the QE environment with extremely low rates. It's generally it makes more mathematical sense, as you mentioned earlier, for companies to engage in M&As or share buybacks. But the long-term consequence is that ultimately, at 5-10 years down the road, we're going to be seeing lower growth, lower long-term, lower secular growth in companies. And I'm curious how active investing or active investors out there are attempting to address this question in the medium to long term.
Well, companies that tend to have an inflection point, and it's either caused by operating performance or some other event, perhaps exogenous to the company or very specific. But if it's, many cases, it's created by investment. And you even saw with the Healthcare Act, certain companies said, we will get $300 million from the federal government if we make this large investment in technology. It's a big investment. It's going to hit our earnings, but the payback is large. Those were the ones being targeted by activists because they showed, again, this headline of a drop in earnings when it really was a thoughtful and certainly long-term value investment. So, it's definitely impacting management teams and boards in terms of how they think about these things. In terms of where we really go in the long term, we'll see. It feels, and again, we're sitting in the beehive where we're defending these. And so it certainly feels that most of the conversation ultimately boils down to, will you sell your company? Will you buy back shares? As opposed to, let's talk about establishing a real plan for long-term growth, better than what you're doing as a board.
Right. I mean, I think the premise of your question assumes that there's a long-term conscience associated with some of these investors, which I think may be a fallacious assumption. But even if you were to assume that, I think their view is that what they're facilitating is a more efficient allocation of capital.
Yeah.
We were talking a little bit about this before. They are basically arguing that if they're able to convince the market that this company is not the right steward of this pile of cash, or sort of this stream of earnings, and that it's better to reallocate that capital back to shareholders, who will then go invest that money in companies that can better sort of invest that capital, or sell the company to someone who can drive that earnings growth, or drive those earnings towards more productive ends. I mean, I think that's the answer they would give you. It's not that their argument is not cut off CapEx. It's that you are not the right person to be making those CapEx decisions because you have not efficiently allocated your capital.
Put the money back to the shareholders, let the shareholders decide where to allocate the capital.
And in the conversation, again, that the CEO of the company that we're working with had with the activists today, he went on, and again, for hours and hours last night about the company and the investment really wants to take it, and all these things and things he's done, frankly, which all really make sense. I said, don't say any of that. They're not going to listen to you. They want to know, are you going to do a buyback or you're not going to do a buyback? Okay, and how big is it going to be? To what number? And I can see it in just the individual nature and the personalities, and there really are Mars and Venus, very different kinds of conversations happening, and they're in many cases talking past each other. One is a very analytical, very numbers-based approach solely, and they're not thinking about the consequence of when you rip out the spinal column of this company, part of the limbs may die, and particularly in the future, we may impair it in some way. And again, I don't think they're all bad. I think the pressure is generally good. We all play better when there's some degree of competition. That's part of the whole system. But the question is, these many cases are very, very self-interested and about their fund and their returns. And don't forget, that's how they raise money, and that's how they're rewarded.
Ladies and gentlemen, let's have a big round of applause for a spectacular panel here. I'd like to thank you guys for joining us. You're great. You're great.
Thank you.